Thank you for joining our Financial Wellbeing for Women webinar. My name is Brownen Horton and I'm one of the financial planners here at Killick & Co. With me tonight, I have Sarah Hollowell from our Tax and Trustees Services and Rachel Winter, who's a partner and investment manager. So this evening is one of the fourth in our series of webinars focusing on financial wellbeing for women. One of the main reasons for a series like this is the plethora of evidence to suggest that men are more likely to invest than women, and that generally women tend to be more cautious, so end up saving into cash rather than investments. We'd all like to lead this change by sharing our experiences and helping explain some of the jargon and terminology used in our industry. So each of these webinars is independent of itself. However, you might like to listen back on some of our previous topics. They include how to start with your money, protecting against the worst case scenario, and planning for life after work. Now, all of these have been recorded and we will send you out these on email later on in this week. So tonight, though, we'd like to really share some of our experiences on a number of ways that you can not only ensure that you have your money working hard for you, but also you can do good at the same time. So while sometimes it can require a lot of money to shop around for ethical or organic or sustainable products, services, and companies, we want to highlight a range of options and further considerations for all budgets and financial circumstances, especially in this current economic climate, with inflation hitting today at 9%. So this evening, I'll pose some questions to Rachel, Sarah, and myself, and we've also included a number of questions which are submitted by you on registration. As well as our discussion, we'll have about 10 to 15 minutes at the end for questions. So please submit these throughout the webinar via the Q&A button. We're aiming to finish about 5:45 tonight, but will depend on the questions from yourselves. So before I jump into my first question, what we'd like to do is run a very quick poll on tonight's topic. So let me just quickly start the poll for us all. And so really we'd like to hear from you about maybe some of the considerations you've had, what activities that you consider you're actually most applicable to you. I'm going to give you a few minutes before we actually release the poll. So don't be shy. There is a number of you with us tonight, so we'll just leave it a couple more minutes. So I'd love to have you participate in all of this. Okay, I think we're just about getting there. Almost there. Okay. Hopefully you can all see those results up there as well. They displaying all right? Yeah, wonderful. So there you can see that probably out of all of it, that the charitable giving, let's see, let me share this. The charitable giving is quite high on 69%. So what we'd like to do tonight is really maybe just give you some ideas of things you can further explore around doing good with your money. So maybe Rachel, if I could start with you, would you be able to give us an overview of how we can invest our money rather than having it sitting in the bank, and how we can ensure that we make a positive impact? Maybe if you could demystify some of the jargon that we use in our industry.
Yeah, sure. Thanks, Bronwyn. And well, first of all, great to see that so many people have thought about ethical investing. And this is something that I think has become really, really popular over the last couple of years. And this is partly because investing in general has become so much more accessible. Because if we go back, for example, maybe 20 years or so, I think investing was considered to be something that was only open to the very rich. But these days, you can invest from as little as £25 per month. There are loads of different robo-investing platforms that allow people to invest very small amounts of money. So I think that's really opened up the investment universe. And also, we've had a big change in pension regulation that now means that most of us now have a pension of some sort. And therefore, because of that, most of us are now invested in the stock market to some extent. So I think that really has made people a lot more aware of how their money is being invested. I've just got a few slides to share so I can talk about this in a bit more detail. 2 seconds when I just get these up and running. Okay, hopefully that has worked. So as always in finance, we have so much different lingo in the industry. So just to break a little bit of this down, we've got so many terms like ethical investing, impact investing, responsible investing, ESG investing. All of these have very slightly different definitions, but broadly they all mean a very, very similar thing. They all refer to investing in a way that makes a positive difference. But the one I'd like to focus on today is ESG investing. And this is the one that I think has become the most mainstream in recent years. And what it stands for is environmental, social, and governance investing. And what it means is to look for companies or investments that have good environmental characteristics. So that could mean looking for companies, for example, that have low carbon emissions or who aren't polluting the planet. We then look for companies that have good social characteristics. Are they doing good for society? For example, we might want to look for companies that are making a positive difference to the community in which they might be based. And then finally, we want to look for companies with strong governance. Do they have an independent board? Do they have a leader who is trustworthy? So these are all different characteristics that we can look for when we're looking to invest in ESG companies. And before I move on any further, I just thought I'd remind you all of the definitions of a few other bits of financial lingo. So first of all, stock, shares, and equities. We hear these words all the time, but often we don't stop to think about what they really mean. So stock, shares, equities, they all mean pretty much the same thing. They mean units of ownership in a company. So if you own a share of a company and that company does well, that company will become worth more, and therefore your share is going to become worth more. We've then got bonds. A bond is a loan made by an investor to a company or a government in return for a fixed rate of interest. So if you're buying bonds, you can have a think about who exactly you're lending your money to. We've then got the index. Now, an index is a hypothetical portfolio of shares that represents a particular market or a particular segment of the market. And an example of that is the FTSE 100 index, which simply represents the top 100 companies by size on the London Stock Exchange. And then finally, we've got funds. A fund is a pool of money that you can physically invest your money into, and that fund will be managed by a professional fund manager. Now, some funds will simply track an index like the FTSE 100, and those types of funds don't require much active management or research, and therefore they tend to be relatively cheap. We've then got actively managed funds where the fund manager is really trying to do research into individual companies or bonds and pick the ones that will really outperform. Now, those types of funds tend to be a little bit more expensive because a lot of active research needs to take place. Now, over the last few years, thousands of new funds have been launched in the field of ESG or ethical investing. But the problem is that there's not really much standardization in terms of how you measure ESG. So we've got the issue that lots of different funds are putting ESG or ethical investing in their titles, but you might be quite surprised at what actually turns up in some of these funds. So that's something I'd really like to come back to and touch on later. But for now on, I'm going to pass back to Bronwen for a bit more about how you can do good with your money.
Excellent, Rachel. So really what I wanted to discuss was how a financial plan comes into this as well. So a financial plan is a little bit like a roadmap. It helps you get from A right through to B. But before we actually put this roadmap in place, we really need to have a clear idea or an understanding of what somebody wants, where they want to get to, and what's really important to them. So we sit down and discuss and explore things like what causes people want to get involved in, or what campaigns are really important, who the people are that are really important to the person, and what purposes do they want to help as well. It's really important to identify those first. Now, a financial plan is not static because life events come along. and changes need to happen to the plan. Hence, it's really important for you to review your financial plan on a regular basis. And so it's my role to come up with solutions and recommendations in an action plan to help people achieve what they want and what's important to them, and ensure that that's suitable, appropriate, and as tax efficient as we can make it as well. Then I work with our investment team to ensure that people have their money working hard for them and efficiently as possible, because this creates a twofold effect. Firstly, they've got money working hard for themselves, so this might be for for the future, but also too that some good can come of what they're actually investing in as well. So an example of this, and like Rachel said before, is what about somebody who's saving for their retirement? So pensions are a great way to do this. Not only are we all obtaining tax relief on our contributions, but we can invest in companies which do good, or in areas which we really believe will have a positive impact, while also too having a strategy in place which might help you pass on wealth to future generations as well. Sarah, what else can people do to do good with their money?
Thanks, Bronwyn. Well, before I go into real details about charitable giving, I'll talk a little bit first about gift aid. Most of you will probably have noticed that when you make a donation to charity, in whichever way you make it, there's an option to claim gift aid, and it's usually by ticking a box. But not everybody understands what this is. Perhaps they don't read the small print. But firstly, by ticking that box, you're certifying that you're making the donation yourself out of your own money. And by doing this, you are enabling the charity to claim 25p from HMRC on top of every £1 that you've donated. Now, there's no lower limit or upper limit. So whether the donation is £1 or £1 million, the charity can claim that relief. However, you're also making a declaration by ticking that box that you have paid or will be paying the amount of tax that the charity are effectively claiming back from HMRC. And this can be either income tax or capital gains tax, doesn't matter, as long as you've paid enough to cover the claim that the charity will be making. So if you have very little or no income and you make a sizable donation to charity, there's nothing from stopping you from making that donation, but just take care about ticking the gift aid box, because it could result in you actually having a tax liability. Now, on the other hand, if you're a higher rate or additional rate taxpayer, so that's someone with income in excess of just over £50,000, you can claim tax relief on any gift aid payments you make on your self-assessment tax return. Well, lots of people might receive most of their income or all of their income through PAYE, and therefore, even being a higher rate or additional rate taxpayer, they don't have an obligation to complete a tax return, in which case you can just request a form from HMRC. It's called a P810, and that will enable you to get that tax relief back. And it's important that you do, and the overall result is that your donations end up costing you less than the amount that you gave because of the tax relief that you can subsequently receive, and the charity receives more than you've donated because of the relief that they're able to claim. So if you make regular significant donations, or if you plan on making a one-off large donation, you might consider a charitable trust or a foundation, some might prefer to call it. Now, a charitable trust is created in a similar way to any other sort of trust, in that the money or the investments that are within it, they're looked after by the trustees, but they are regulated by the Charities Commission. And to create one, you have to ensure that the trust has got a specific purpose. So the main rule is that the trust has to be created for the public benefit. And there are numerous categories, and these can be found either on HMRC's website or on the Charity Commission's website. But examples are being health, arts and culture, heritage and science, or animal welfare. And there are far more than on this list. So unless you plan for your charitable trust to support something really obscure, then it should get through okay. It should fall into one of those categories. And then once you've decided on your charitable purpose, you can choose whichever you like. You'd give the trust that you're creating a name, and you have to be careful because it can't be too similar to the name of an existing charity. And then a deed would be created and an application would be made to the Charity Commission. And then if approved, your charitable trust then becomes itself a registered charity, which means it's got great flexibility. And donations into the charitable trust by you or anybody else would attract tax relief, both of the person making the donation, and the trustees would then submit a gift aid application to HMRC on behalf of the charity. So the same way the gift aid would work as if you were just making a normal charitable donation. There are numerous benefits to making a charitable trust. So the trust itself doesn't pay any income tax, capital gains tax, or stamp duty. You, along with the trustees, can have a say with how the money gets paid out, to whom and when. And the charitable trust, and this is one of the most important points perhaps, is that it can continue perpetually. So that means that it can carry on doing good even after you've died. And there are many charitable trusts that are in existence that have been going for well over 100 years. So it can be quite onerous to set up. It can take quite a long time. There's a lot of form filling and so on. And if you don't want to go to the trouble of setting up a charitable trust, or if you don't feel that you have a large enough amount to give away to justify a charitable trust, then a good alternative is to open an account with the Charities Aid Foundation, or CAF. And you can open a CAF account with a one-off payment of £100, or you can set up a direct debit of at least £10 a month. And CAF then make the gift aid claim on the amounts that you put in, and you choose then when payments are made from this account and to whichever charities you wish to benefit. And there can be fees on these accounts, which are easily found on CAF's website. But going back to charitable trusts, as well as putting money into the trust during your lifetime, you could create a charitable trust in your will, or you could make an existing charitable trust a beneficiary of your will. And obviously, as I'm mentioning wills, I should remind you that any gifts to charity in your will are free of inheritance tax. I've mentioned it before in a previous webinar, but if you haven't heard that, then obviously it's something that people might want to take into consideration. And what's important to note is that if more than 10% of your net estate, that's the estate after deducting the nil rate band, IHT exemptions and relief, is given to charity, the remainder of the estate can then benefit from a reduced rate of inheritance tax, 36% rather than 40%. So other beneficiaries can certainly benefit from you gifting in your will as well. And that's something that's often overlooked when you're writing a will, is the fact that if your entire family were to be wiped out in a catastrophic event, now obviously nobody would want that to happen, but it could leave you with no beneficiaries in your will. Or if you don't have a will and there are no family members who would benefit from your estate under the laws of intestacy, then your estate could well end up in the hands of the Crown. So I'd certainly recommend that you include some sort of disaster clause in your will so that your money can end up going to a charity that's close to your heart rather than it going to the Crown. But if you want to do good with your money, it's not necessarily always charities that you want to give to. You might want to consider family or friends as well. And I think, Bronwyn, you'll be able to tell us about that.
Yeah, I think there's obviously a number of ways that people can, help their loved ones. And I'm just going to touch on a couple of these now. So one is gifting of money and assets, which, can happen during your lifetime, or like Sarah just said, on death through their will as well. So when we look at, lifetime gifts, one of the main considerations is, as a financial planner, we're always looking to ensure that you have enough. Can you afford to actually give that money away while you're still living to help family? And one thing that we do is we always check people's cash flow and potential future expenditure as well. So what we want to do is we want to ensure that people can cover, their day-to-day expenses, that you have a rainy day money set aside for emergencies, and future planning expenditure such as cost of care later on in life. Because really it's important that we look at the impact on your financial position and possible inheritance tax liabilities as well. So for some people with large investable wealth, a plan of actually gifting may be needed over a couple of years or number of years to reduce their potential IHT liability. So sitting down and actually planning that out is really quite important. Another area that I'd like to touch on is those of you who have children as well and want to give money to them to help them invest for their future. So one thing to be very careful of is if a child does earn more than £100 worth of income from their investments, which has been derived from a gift from a parent, the income is actually deemed to be that of the parent. So this means that it's added to the parent's income tax, and it could actually be taxed quite heavily as well. So to assist here, parents may consider actually setting up a junior ISA, where parents and wider family members and loved ones can contribute up to $9,000 each year. And then the tax growth for the child, like a normal ISA, is tax-free. And like you said, another way to help families and charities is through your will. So it's really important to have those in place, because if it is important to you, then you want to make sure that your wishes are executed as well. So Rachel, you talked briefly about ESG investing at the start, and Sarah and I have touched on other areas such as charitable trusts and JISAs, so junior ISAs, that may require investing. Could you tell us a little bit more about how ESG funds are put together?
Yeah, sure. So I think this is really important to look at, because these days there are thousands of different ESG funds, because it's such a popular area, and therefore loads of fund houses have launched new ESG funds because they know it's popular and they want people to put their money into those funds. Now, some of these funds have been accused of what's called greenwashing, where they've put out some ESG marketing and claimed to have quite green credentials, but actually when you look at the contents of some of these funds, they're really not that green or ESG focused at all. But that aside, if we look at all the ESG funds on the market, they have such a difference in their contents, and arguably you could say that is a good thing, because ESG or ethical investing is very subjective, and something that I think is good or ethical might not align with what you think is good or is ethical. So it's really important to get an understanding of what's in these funds, and also the methodology that these fund managers are using to actually construct these funds and pick the investments for them. So I was just going to touch on a couple of the main methods of putting these funds together. So I'm just going to pull my slides back up. So two of the main types of screening processes are called negative and positive screening. So with negative screening, how it works is the fund manager would pull up a huge list of different investments, and then they would simply take out the ones that don't comply with their regulations. So for example, they might take out tobacco companies or defense companies or fossil fuel companies, but you tend to end up with still a very long list of shares. And with this particular method of screening, it tends to be quite quantitative or quite numbers focused. And actually, I would argue that that's quite a difficult way to measure the ethics or the ESG characteristics of a company, because at the moment, we don't really have a standard way of measuring those criteria. I think it's better to actually use a positive screening approach, whereby a fund manager would really look at each individual company in detail and discuss what they're doing to try and make a positive difference. And often you can't do that just by looking at numbers. Often it involves things like talking to the management and trying to assess what the culture is like at a company. So personally, I prefer the positive screening approach, where you would start with no companies, and then into your fund, you would simply add the ones that you believe meet with your ESG criteria. But let's have a look at a couple of examples of funds that have used these two different methods of criteria. Now, towards the start of this webinar, we talked about indexes. So we talked about the FTSE 100 index, which is the 100 biggest companies in the UK. There's also an index called the FTSE All Share, which contains all the companies on the London Stock Exchange. And then there's also a so-called ethical version of that, which is called the FTSE for Good index. And this is supposedly the same as the FTSE All Share, but with all the poorly performing companies from an ESG point of view having been taken out. And actually, a lot of UK-based ESG fund managers will be basing their funds on this particular index. So let's have a look at some of the things that are considered when this index was being put together. So on the environmental side, they were considering climate change and pollution. On the social side, they looked at things like health and safety and human rights. And then on the governance side, they looked at things like tax transparency. So that all sounds pretty good on the face of it. But if we go and actually have a look at what made it into this for good index, actually it seems like the scoring bar for ESG was in fact quite low. So here on the left, we've got the top 10 holdings of the FTSE All Share Index. So if we have a look, we've got Shell, we know that's a big oil company, that accounted for 6.8% of the index. We've then got AstraZeneca, a big pharmaceutical company. We've got HSBC, a big global bank. We've got Unilever, the maker of Ben & Jerry's. Diageo, an alcohol company, GlaxoSmithKline, another pharmaceutical company. So that's the FTSE All Share. And then on the right-hand side, we've got the FTSE for Good index. So if we consider that this is supposed to be the same as the FTSE All Share, but with the bad stuff taken out. But if you have a look, the biggest holding in this is still Royal Dutch Shell. And if you look at the weighting that it has into Shell, it's actually a lot bigger than the weighting that the normal index has into Shell. So that might surprise quite a few people who thought they were buying into a so-called ESG fund. We've still got HSBC, and that's a bank that has, it's been fined for money laundering offences. It makes a lot of revenue from China, which has been criticised for human rights abuses. We've got a couple of big mining companies in there. We've got Rio Tinto, we've got Anglo American, and those, some might argue, are not doing particularly good things for the environment. So it's just really important to have a look at what's in these so-called ethical or ESG funds and just make sure that that aligns with your particular values. If we then move on, we can have a look at a fund that uses a positive screening process. Now, this is the Lion Trust Sustainable Future Global Growth Fund. And I've just picked this one because this was one of the most popular ESG funds in the full year 2021. And it's just quite interesting to have a look at the breakdown of different sectors that the fund has invested in. And you can see that the top two are information technology and healthcare. But what's quite interesting, if you look down the list, there's no energy there, there's no fossil fuels, and there's no oil. So you can see that actually this positive screening approach does seem to come up with quite a different breakdown of actually what goes into the fund. What you could also do, you could have a look at the United Nations 17 Sustainable Development Goals. So these are 17 goals that have been put together by the United Nations that the UN would like the world to reach by the year 2030. And they're all on the screen here. So there's things like no poverty, there's zero hunger, there's affordable and clean energy for everyone. And what you can do is look at companies that have signed up to try and meet these goals. So if you're investing in individual companies, be that shares or bonds, you can have a look at what these companies are doing to meet these goals. And any company that has signed up to them will produce a very lengthy annual report saying exactly what they're doing to try and meet these goals. Or you could have a look at different funds where the fund managers are actually using these goals in their company selection processes. So that's something you could do. And when you're looking to invest in different funds, I would suggest that you have a look on Morningstar. Now, Morningstar is one of the biggest fund databases in the world. There are lots of different bits of research on there, and you can have a look at the ESG section, and you can get a huge list of all the different funds that are available, and you can quite easily have a look at the contents of those funds and just make sure that they align with what you believe should be in a so-called ESG or ethical fund. So that's it from me. That's about how you can look at the contents of these ethical funds. Now back to you, Bronwen.
Wonderful. Thank you, Rachel. Right, we're now going to move into our questions as well. So what I suggest is if you do have any questions, please do put them in the Q&A for us as well. Please don't be shy. There's no such thing as a silly question, and we're happy to go back through some of the things we might have covered if you'd like to sort of discuss them in further detail. Now, one question which has come in, Rachel, that if I could get you maybe to answer first off, is what is the performance of ESGs compared to any other sort of investments? Would you be able to cover that for us?
Yeah, sure. It's actually quite a difficult question to answer because ESG investments haven't been around for that long, but also no one has quite agreed on exactly what an ESG fund or investment is. So it's quite difficult to know what we're measuring. But I can say that if we look particularly at the G proportion of this, so if we look at the governance of companies, I think we can say that companies with good governance are less likely to be involved in fraud. And therefore, it's probable that because of that, ESG investments would be likely to outperform. It's common at the moment for a lot of ESG funds to not include fossil fuels. So if we go back to 2020, when most of the world was in lockdown and fossil fuels were not in demand and were doing very poorly, then actually the ESG funds that didn't contain any fossil fuel stocks massively outperformed. However, the opposite has been true this year because the oil price has gone sky high because of the war in Ukraine, and therefore ESG funds that don't have any fossil fuels have probably underperformed.
Excellent, great, thank you for that. And Sarah, maybe you could cover, let me just bring up the one of the questions there. Maybe you could cover this one. Is there a way of giving assets other than cash to charities?
Yeah, absolutely. Other than the usual items that you might give away to a charity shop, not just clothing, furniture is often accepted by some of the larger ones. A lot of charities will be happy to accept donations of shares. Some might ask that you would sell those shares first on their behalf. People might be a bit worried about that, thinking that they might incur a capital gains tax liability. But if you're selling personally on behalf of the charity, then you're not subject to CGT on those disposals. So you can gift shares to charity tax-free, as you give money tax-free. And if you have got small numbers of shares, or if you've got some shares that are worthless, there are companies such as ShareGift that will accept those. You can also gift things like land and buildings, artworks to charity, but you'd need to make sure first that the charity is happy to accept it, because although you want to make a generous gift, sometimes they might not be able to do anything with it. Obviously, sometimes museums and so on might want something on loan, artworks and so on, but you'd need to check that the charity would be happy to take whatever it is that you wanted to gift.
Excellent, thank you.
Can I ask you, Bronwyn, what do you think that everyone on the call should do today?
Yeah, I think that's actually a really, really good question there as well. I think the most important thing is to really work out what's important to you so that you can start building this into your investments and your financial plan. So when we sit down, we always talk to people about, what's important to them. Do they have any ethical views? Are there things that they don't want to hold in their investment portfolios? So this is really important to keep this in mind, and it's a good starting point for everyone to start reviewing all of your finances first and find out what you have. So it might be going and having a look at your pension and see what it's actually invested in, and is that aligned with what your values are as well. Really important there. A great question there. So I've got a few more that are mainly maybe sort of more that Rachel could answer. So Rachel, firstly, as a new investor at this volatile time, interest rates increasing and possibly a recession, what would you expect of your investment manager to sort of put your money all into the market at once, or drip feed it in? What's your sort of view there?
Well, it should be your personal preference. So if you are setting up an investment account with a genuine person who's an investment manager, rather than using some sort of robo-investing platform, then you should be discussing that with the investment manager. My view is that it's generally less risky to drip feed money into the market over a certain time period. That would normally be 3 to 6 months. And that's quite a good thing to do in volatile times like now. And so you might be buying some investments when the market is low, you might be buying some when the market's a bit higher, but if you're just gradually putting that money in over time, then it should really smooth out, and you as an investor should have a less volatile experience. But that said, markets really have sold off quite heavily over the last 6 months, and that's for a number of reasons. Partly inflation going up and therefore interest rates going up as a result of that, and then also uncertainty over this Ukraine situation. And some markets are off by over 20% this year so far. And actually, for long-term investors who do have quite a long time ahead of them, I would say it's quite a good opportunity. So personally, I'd be happy to put not all of my money into the market all at once, but perhaps a little bit more at the outset, and then to drip feed in the rest.
Wonderful. Thank you, Rachel. And Sarah, maybe one for you. So earlier you mentioned about including a disaster clause in our wills in relation to charitable trusts. The person's not sure if she quite understood. Could you just clarify and maybe just go over that again about the importance of having that disaster clause in our wills?
Yeah, of course. I think that when we write our wills, we all think about who we would like our money to go to, and you might leave it to your children, and if your children have already died, then it might get left to other children. So there's usually a sort of sub clause there. So you say, well, I'll give it to this niece or this friend, but should they not survive, then the estate could be split between the remaining beneficiaries, or it can go to their children or their children's children. So that's how it would usually work. But sometimes people might leave a gift in their will, say to their children, and should they not survive, then it would go to their children or to the children who have survived. But it can happen that if you are in a terrible accident, your children might also be in the same accident and they haven't reached an age where they've got their own children yet, which could leave your will empty in terms of who that money is actually going to go to. So usually what would happen, if there is a bit of the will that doesn't work, it would read back to the bit of the will that does work. But when you have got this disaster scenario, if you haven't got anything in place, then it would end up going to the Crown. And there was a relatively recent case in the last few years where something like this did happen. It's quite a high profile one. There was a dreadful helicopter accident that wiped out an entire family. And so it does happen, as dreadful as it might sound. And so just by adding another sentence in your will saying that if all my beneficiaries should die, then I would like my estate to go to, and then you could list 1 or 100 charities, however many you wanted to. It just means it would end up in a place that would be closer to your heart rather than just going to the Treasury.
Brilliant. Thank you, Sarah. So please don't be shy tonight. You know, if you do want us to sort of repeat something that we've gone over in more depth, or if there's something that's really pertaining to you that you'd really a burning question, please do ask as well. We're here to help. Rachel, one for you. How would you recommend getting started for a complete investment beginner?
There's so many different ways. So it depends, I suppose, what your objectives are and how much money you're starting with. So if you're just starting by perhaps saving a little bit on a monthly basis, there are lots of different robo-investing apps out there. For example, Killick has one called Silo, where you can invest upwards of £25 per month. Killick and other investment managers too have advisory investment services. So if you'd never invested before, you could come and have a chat to one of our advisors and let them know what you're wanting to invest in and what your objectives are, perhaps if you have any ESG criteria, and then that investment manager can help you to select some investments that are right for you. And then you could also, like I said before, you could have a look on a big fund database like Morningstar, and you could select your own funds there. But if you've never invested before, that might be quite intimidating. So personally, I think to start by talking to an advisor is a good way to go.
Excellent. Thank you, Rachel. And maybe just another one for you as well. You talked about the FTSE for Good before and comparing it to the FTSE 100. Could you please explain the ratings given to these companies in the FTSE for Good or the FTSE 100 companies and how they work?
Well, unfortunately, I can't really, and this is a big part of the problem. So the measures they use to decide which companies make it into that FTSE for Good index are actually very opaque. So they're telling us what criteria they're considering. So they're saying they're looking at things like climate change, but how are they actually scoring it? And they can't be placing that much emphasis on it if a company like Royal Dutch Shell makes up nearly 10% of that FTSE for Good index. So that really is part of the problem. And that's why I just think it's really important to actually have a look at the contents of any fund that you're thinking of investing in. I'm sorry, I can't be more helpful there. I too would love to know more about how they're selecting these ratings.
Yeah, no, thank you for that. And Sarah, one that I might send your way is, could you please clarify the position, re tax implications of giving more than 10% of your will to charity?
Absolutely. So first of all, it's important to remember that it's 10% of your net estate. So if you are considering doing so, make sure that the wording is correct in your will and don't just say 10% of my estate should go to this charity. Make sure you say 10% of my net estate, because the difference can make, leaving that wording out can make quite a difference to the overall inheritance tax position. So if you do gift 10% or more of your net estate to charity, then the remainder of your estate, instead of being assessable at 40%, will actually be assessable to inheritance tax at 36%. So there is a point at which, even if I can't remember exactly off the top of my head how much it is, but if you give a certain amount to charity, I think you have to have quite a large estate for this to work, then your beneficiaries will still end up better off, even though you've gifted 10% to a charity. So I can actually look that up, and because I think I saved it before as a chart after a previous webinar. So perhaps we could share that afterwards, if anybody would like that information, because obviously you want to do good, but at the same time you don't want your beneficiaries to feel as though they've been perhaps hard done by or anything. They might be counting on you dying and leaving them lots of money, and obviously it's your will, it's entirely up to you. But I'll send that chart around, because there is a point, that sweet point, where you're able to give away a nice chunk to charity. Your beneficiaries don't suffer at all.
Brilliant. Thank you, Sarah. And again, just please, any questions for us, do fire them through. The next question is, are there any, probably Rachel, if you could maybe tackle this one for me, are there any specific funds that focus on women investing in female-led businesses?
Yeah, actually, this has been quite popular over the last couple of years. So this category would be called gender-focused or gender-based investing. And there certainly are funds that firstly look for companies that have a good spread of males and females in senior positions at that company. You can then look for funds that invest in companies that are specifically led by a female. And also there are funds that do have a female fund manager as well. So if you're looking to invest in something a bit more female focused, there are lots of different options out there.
Excellent. Well, look, I'm just going to open up for anyone else. I think we've covered most of the questions that have come up. If by any chance you have any questions afterwards, so once we sort of close the webinar, if there is anything that comes up over the next couple of weeks, please email them in. You can email into events@killick.com, but we will have an email out with all of those details. So we've come to sort of the end of tonight. Like I said, if you do have questions, please do email us. We are more than happy to help. Here at Killick, we have a real big focus on education for people. We have a huge amount of resources. Also on our website, we have a sort of a section called Killick Explains, where one of our head of education, Tim Bennett, does a huge amount of videos on a range of different topics. So if you would like to extend your knowledge in this area, please do use those resources as well. Also too, we will after tonight have a survey out as well. So if there are any topics of interest that you would like us to discuss, please do feel free to let us know. It's really important that we cover things that are really important to you and that are either concerning you or that you'd like a little bit more information on as well. So that follow-up email will also have all of the recordings out as well of all of our previous webinars as well. So getting started with your money. So for those of you who asked us about, how do you get started with investing, we did cover that in our first one. In our second one, we covered about protecting for your worst case scenario. So, really looking at things like wills and having those things in place to protect against those. And then our third one looked at, what happens after you finish work as well. So focusing on pensions and lifetime savings as well. So with our next webinar in our series, we're going to take a little bit of a break over summer and return in September. We're going to focus on the start of the new school year. We're going to be discussing reviewing your money. So it's a good time to start looking at all of that and focusing on kids and family as well. So please keep an eye on your inbox for any invitations coming out. I'd like to thank Sarah and Rachel for joining me this evening, and thank you all for joining us. Please enjoy the rest of your evening.